Good morning. You're watching the market right here on ET Now. Couldn't have asked for a better finish, at least as much as we could do given the market construct that we had last week. On Friday, we managed a record closing high. Still not a record high for the Nifty, just inching towards that mark, actually optically almost there, a few points shy, and we should make it to that mark. This morning, the SGX Nifty is once again indicating a stable start, but a quiet one at that. So yes, while we've seen a record closing high thanks to the Reliance Group, or rather Reliance was one of the key contributors, the HDFC group of stocks as well came back very, very strongly. And yes, I think more than the Nifty, the underlying bull market is in the broader markets. I mean, the market breadth is already at a 20-month high.
Yeah, so, a lot of talking points. I wish market would have touched our all-time high on anniversary. The ring of that really would have been perfect.
It can do today, considering our anniversary was actually on Saturday.
Well, I mean, belated all-time high, it's okay. But the point here, Aisha, is we must recognize and realize that when the market is in momentum, and I'm going to use Newton's law here, which is that if a body is in motion, it could stay in motion for a longer period of time till an external force is not allowed. That means that if markets are in a momentum groove, they can remain in momentum groove longer than you anticipate and longer than you expect. And I think that is where the entire market distribution actually has started. The market breadth is improving with each passing day. The market is seeing more and more participation. The FOMO crowd has kicked in. While we are witnessing both globally and locally a extraordinary comeback by the bulls in the month of April, May and June, what is interesting here is that the left out syndrome, I think, is still visible. So I have reason to believe, which I've been maintaining, that markets will make a new all-time high. Mid and small cap stocks will participate, and mid and small cap stocks I don't think have peaked out. This is the picture which is important for me. Let's stay here, please. Valuations. That for me is a basic construct on which I look at anything. The Nifty valuations currently are below its 5-year average. So markets may be nearing it an all-time high, but this market is nowhere close to its peak. And I'm looking at the 5-year average, both for the small cap index and for the mid cap index. So for me, that in a sense is the preamble of what is happening. The second layer is flows and liquidity, which I think is strong given the news which is coming from China and how the FOMO crowd is coming in. And third, I guess, is the construct of the market. And this is very interesting here. Look at the market when we were at an all-time high last time. So 18 months ago, 19 months ago, we were at an all-time high. The Nifty. What was the valuation level that time? What was the retail participation? What was the interest rate curve? What is the interest curve right now? And what happened after that? On each parameter, I think the surrounding is favoring the bulls. When we hit an all-time high in October 2021, slightly long answer here, interest rate hike had started. Right now, we are coming off an interest rate hike. The war hit us. The valuations started peaking out and earnings collapsed. I think we are at the reverse. Inflation is down, flows have come back and earnings are expanding. So fundamentally, technically, I think if you have not participated, you should participate. If you are in the game, don't sell. I don't think this market, fundamentally, technically speaking, is telling you that it wants to peak out.
And just to add to that, at that time the FI longs were close to 70%, which is right now at around 55%. So there's that much room available as well. But yes, cues are skewed on the positive side. Asian markets haven't opened with that much of a gusto because Hang Seng is down a good 0.5%, etc. But it's SGX Nifty which is suggesting we are likely to start at all-time high levels above the mark of 18,900 at this point of time. So we'll keep tracking that when that happens, and that's also been supported by the global cues that we have got from the US, right? Of course, on Friday there was a mixed close happening wherein the S&P closed in the red, but if you look at the week gone by, that was rather stellar for the entire US markets. In fact, it clocked gains which was around 2.6% for S&P, and it's the best performance that they've delivered since March, and it's the first such streak that we have seen on S&P given the fact it's been closing on the positive side for 5 consecutive weeks since November 21, and ditto for Nasdaq as well. In fact, it's the best streak that we have seen since the month of March itself. So a lot of positive cues actually aligning itself. And even if you look at the US VIX, it's at 52-week lows. It's off the March highs by around 50%. And if you compare it to the 52-week high levels, it's off by around 60%. So Nikunj, it's not just that there is of course, a lot of room and levers available on the upside, but there's no that exuberance that we were talking about. It's not those, the tail stocks which are wagging right now. It's the entire market breadth which is quite healthy.
So Nisha, it will happen. That's the construct of the market. See, markets, they follow a cycle. It's just that the characters, which is names, and the participants, they change. But the market in terms of a cycle, it will always follow a cycle, and that's really the biggest truism we must realize and we must recognize. So where are we in the cycle? That is what we must recognize. I think the belief that India is the, India is where you want to be, I think that is a global mood shift in that. Second, that global shift, I think, is still an ongoing process. I don't think large allocations have come back to India, considering that we are still negative for the year. Guys, we're still negative for the year if you look at the YTD FI flow. And if I add back what FIs have sold in 2022, I think before it neutralizes also, a lot of money should come back to India. Second, I go back to that valuation point again, and let's look at that. Markets will peak out, either valuations have to become very euphoric. I'll be slightly repetitive with this one, but let's look at it. No harm in looking at the data, which I think is the most important data for me, the valuation picture. Nifty is below its 5-year average. Small cap index is way below its 5-year average, and the mid cap index, even though the index has touched an all-time high, it is way below its all-time average. They peaked out when valuations were different. So the peak, I think, is the October 2021 data, and we are nowhere close to it. And for me, I think the market will peak out, and I'll tell you why it will peak out, barring any macro changes which come on the horizon, which we don't know. Those are events you cannot forecast, but if they have to happen, market will adjust. I think when demand and supply will change. And that, I think, is happening. Look at the number of banks which have started talking, which have indicated to their clients that it's good time to go and hit the market. Patanjali is planning an OFS, a big OFS. We understand that there are a lot of other companies which are planning to either go public, or OFS and QIP started. And that is the time, I guess, when the demand will succeed supply, or fresh flows will go into some of these names, and the secondary market buying will stop. I think we are not there yet, but come July and middle of July, I think you will see a race of new IPOs, OFS and QIP, and for me that is the turning point. I don't think we are there yet, but we will reach there yet, and that for me is a full circle. It's like a full circle has to be drawn. The pendulum has to swing from oversold to neutral to participation to FOMO to participation, excitement, euphoria, and then dumping of stocks. That's it. Simple.
Yeah, absolutely. Okay, let's also look at all the events that are lined up for the week ahead. Nikunj just highlighted what's happening within Patanjali. By the way, Patanjali is looking to meet several institutional investors, as we understand. Today as well as tomorrow, the meeting is organized by Antique Stock Broking. The promoter, remember, needs to reduce holding to about 75% from their current, and they aim to comply with the minimum shareholding criteria by the first half of the fiscal. So the 5.82 stake that they need to offload, that's valued at about almost 2,400 crore rupees. That is what the management had indicated when they last spoke with us. So this is going to be one stock wherein you can expect some fireworks. We will of course get you more on the buzz that we're picking up on Patanjali. But in the meantime, couple of key events as well lined up today. Remember, Prime Minister Modi begins his state visit to the US. This of course is going to come in amidst much fanfare. He's also going to from there be visiting Egypt. And that said, we are also this week, considering it's going to be a shortened trading week when it comes to the US. Remember, today the US markets are on the July 19th holiday. We are expecting the housing market stats. We're expecting the Fed Chair Jerome Powell as well, who's going to be testifying before the Congress as part of his semi-annual testimony on the monetary policy. So a couple of important data points. And of course, for our markets, we're going to count down to the all-time peak.
Yeah, and Aisha, the ring of an all-time peak just makes you wonder that, all-time peak, and then what's next? I think you will make a new high, and go beyond that, because this new all-time high I think is coming after a gap of almost 18-19 months, which means markets have consolidated enough. Let's look at the data. I think this is the most important data, that what is the difference between the last all-time high and this all-time high, and that I think is very, very important. The construct of the market is very different. The global markets are very different. The interest rate regime is very different. Valuations are very different, and FI positioning I think is also very, very different. This for me I think is the most important indicator of of where markets are. I think it should be October actually. Repo rates are declining, yields are topping out, crude prices have gone through a up cycle and a down cycle, and the FI holding, which was as high as 75% in December, today stands at 55%. So there is no participation, which is valuations are not stretched, retail participation is low, open interest is not there, crude is down, and interest rate regime is favorable. Everything tells you that markets are nowhere close to its peak. I'm sticking my neck out. Naresh Mirani, looks like we'll make an all-time high today or tomorrow. After you make an all-time high, do you think this market will sustain? Do you think this market will bulls will get a spring in their stride?
So I would say the heavyweights could get say a pickup. So on a new high, we should see more momentum on the heavyweights. Over the last couple of weeks, the small caps and the mid caps, broader markets have continued in momentum. So it is the heavyweights which needs a pickup and a push. So the view is we go towards that 18,800, 900 mark. And if we see that happening with a couple of names taking the momentum, say for example, Reliance Industries has moved up. If we see a ICICI Bank move up, or a FMCG name or a IT bounce back, we could see much higher levels on the Nifty as well. So the expectation is a new high should give a fillip to the large cap heavyweights rather than the mid caps and small caps.
Yeah, and that participation from large cap has been missing, right? So that's par for the course. But what about Nifty Bank? It made that life high level of around 44,500 thereabouts. But since then, it's cooled off materially. Is that going to be the case for Nifty? And what about Bank Nifty itself? What are the levels you're watching?
So if you look at the indices, the Bank Nifty, the problem is say 25% of the index is HDFC Bank, another 23-25% is ICICI Bank. For the last 2 weeks, both the stocks have gone nowhere. And add to it, you have another 10% coming from Kotak Mahindra Bank. So these three heavyweights, which are the major part of the index, have seen zero trend and zero momentum. Say 930, 940 is where ICICI gets stuck. So if we see any of them break out, once we are about 950, 960 on ICICI, that is the one which could trigger the upside. So the bias is positive, waiting for stocks to actually give that recovery. We've seen a correction enough in HDFC Bank as well as Kotak Bank. They're closer to supports. But ICICI Bank could be a surprise on the upside, wherein if the stock breaks out of this range of 930, 960, could actually make a big move. So overall would be positive on Bank Nifty, would be actually looking out to buy on the way up going forward.
Okay, so Naresh, let's have your stock ideas as well.
So the first is a buy on Grasin. The stock is making a huge cup and handle or an inverted head and shoulders formation. The stock is very close to that breakout point of 1780, 1800, testing that for the last two sessions. The rest of the cement names have done much better. The stock is shaping up for a bigger breakout. Keeping a short-term view as of now, a stop loss at 1730 and a target price of 2000. Second is a buy on BHEL, which is now finally coming back to that 8590 mark. The stock generally sees a lot of volatility, so it has done that move from 8590, went down lower, came back, then took a dip. So making a strong formation now, and a lot of catch-up to be done compared to the capital goods space, wherein everything has done well. So this could be a surprise going forward. Stop loss at 84 and the target price of 100.
Kunal's also ready. Kunal, all-time high this week, and then if markets hit an all-time high, will that be a breakout moment for Reliance, Axis Bank, ICICI Bank, maybe an Infosys, the stocks which are in hibernation, or an all-time high in a sense will push mid and small cap stocks more higher?
I think it's going to be the first part more. I would believe that large cap should start to participate. We've seen flashes of signs, Nikunj, in the last couple of trading sessions. So previous week, I think mid of previous week is where we saw Reliance picking a comeback. You've seen PSU banks, for example, on Friday, bouncing off from their previous major swing lows. many of the underperforming sectors as well as stocks are starting to make a comeback again. We've seen that happening in the last couple of days, and that's a very strong ingredient that we could probably be going into a phase where the large caps would start to participate as well as start to fire up. Even the likes of Infosys and TCS saw good recovery on Friday's trading session. So I think all in all, I believe that the sentiment for the large caps should start to improve. Now, the most important feature is the India VIX, because we've seen historically that whenever the India VIX has gone to that 10 to 10.5 odd band, and we are now nearing probably a 10-year low for the India VIX on closing basis, which is I think around 10.4 levels. And we've seen that happen, that whenever that happens, we've seen the indices get into a free-flowing uptrend, which lasts for many months on a trot, and by percentage gains, we think we've seen more than 10 to 15% rise on the index post that happening. So I believe that the uptrend is here to sustain. We are not just looking at a possible or a potential break of the new high for the index, but more of a sustaining of the previous new highs for the index.
Okay, and Kunal, tell us, what stocks are you betting on? What's going to lead the charge?
So two large cap names, Reliance and SBI. The first one is Reliance Industries. Again, expecting the stock would carry forward the last 3 or 4 days of consecutive up move, suggesting a buy with a target of 26.50. Stop loss could be kept at 25.25. And the second would be a buy on SBI. Again, I think a stock which has corrected in the last one to 1.5 odd month. It's now come back towards a very strong support around this 570 odd mark. So the risk reward is extremely favorable to initiate a buy, suggesting a target of 625, stop loss at 550.
Okay, so those are the recommendations coming in, sticking with the large cap names, Reliance Industries as well as SBI. But time now for a quick break. But as we do that, as part of our 14-year anniversary celebrations here at ET Now, we got you the biggest market voices. Listen in to Manish Chokhani, Sameer Arora and Atul Suri as they share their views on where the market is headed, stocks and sectors to watch out for.
Couple of years is really the period of infrastructure, capital goods and defense, railways. All these companies are really going to benefit a lot. And I don't yet think the prices have captured that fully. As you continue, again, our old theme, the financials, are at the center of everything. So while the last few years they've all gone after the retail guys, I think this whole corporate banking, the PSU banking, pack. If you take the top 3 or 4 banks after SBI, they're all in 30,000 crore type PPOPs, looking evident, which are large numbers. SBI will be north of maybe 1,25,000 crores. I don't know. I think you just interviewed the chairman. The numbers are going to be staggering coming in. HDFC itself will be probably close to a 1 lakh crore PPOP.
So for that, my simple thumb rule is compound at about 13-14% and see whether 1.14 to the power of 5 into 66,000, does it become 1 lakh or no? So plus minus it would be there. But right now, yes, right now, next at least 30-60 days, because I can't commit here forever. Depends on how the prices move, but right now I would think that they are there for some time.
I saw the Sensex at around 1,000. So that's like what you're talking about is a 50, 55, 60% move. So I'd see that there's no reason why we should get there in about 4 to 5 years. For us, are actually shockingly, controversially underweight the large banks. And we are overweight the NBFCs. And I think that in that space, well, it's all doing great, yeah.
Welcome back. Well, the ring of the all-time high is what is visible on the SGX Nifty at this point of time, 18,918. But what are the stocks which are going to be in spotlight? Well, let's go across to our research team to find out some of that. In fact, multiple news flow happening on Manappuram Finance as well, after the Kerala High Court has managed to quash the FIR against the company, but it still has to pay a fine of around 20 lakh rupees that the RBI had imposed. So Amit is joining us to help us understand the implications of the same. So Amit, hi, good morning.
Well, there are a couple of news flows coming in from Manappuram Finance. The first positive one is the fact that the FIR, which was the basis on which the ED had conducted investigation under PMLA on Manappuram Finance, now that has been quashed by the Kerala High Court. Now, quashing of the same should significantly improve the chances of the ED case getting resolved quickly, and if that happens, then this was a major overhang on the share prices of Manappuram Finance, which would go away, and the focus of investors would now completely again shift to fundamental improvement or fundamental growth going forward for Manappuram Finance. So that is the positive news coming in. On the negative side, RBI has fined around 20 lakh rupees for non-compliance with certain provision. Now, RBI action is based on deficiencies in regulatory compliance according to the filing. Now, during FY21, an annual inspection by RBI had made observations on loan extensions given to existing customers and also alluded of evergreening of accounts. Now, management was served a show cause notice back then, and the hearing was ongoing, and finally RBI has come out with a fine of around 20 lakh rupees on Manappuram Finance. Now, RBI has imposed this penalty for regulatory non-compliance for non-classification of certain overdue accounts as NPA, which is a tantamount to evergreening of accounts. And the second reason for this fine was non-compliance of mandated LTV of 75% on certain accounts during FY21. So a couple of news flows, but the positive news flow coming in from Manappuram Finance is the fact that the Kerala High Court has quashed the FIR, which was the basis on which ED had conducted investigations of the company.
Okay, Samit, we'll leave it at that. That's Manappuram Finance. That's going to be another stock in focus, as would be Titagarh Rail, considering the brokerage firm Antique is now bullish on this one and has initiated a buy. It also believes that the company has the capacity to grow its turnover to over 10,000 crore rupees over the next 5 years. Ashesha is here with more on the same. Ashesha?
Well, yes, railway stocks have been buzzing over the last many trading sessions, and today, of course, Titagarh Wagon, one specific stock that will be in focus, and this is on the back of a note that has come in from Antique, where they've initiated coverage with a buy rating, and they've given a target price of 694 rupees per share. Antique believes that this is a jewel in the making. They say that company has created a manufacturing setup which its peers will not be able to replicate. As far as their turnover targets are concerned, Antique says that the company has the ability to increase its turnover to about 10,000 crores over the next 5 years. This will indicate an earnings CAGR of 53% over the period FY23 to 26 and a return on assets of over 25%. They also say that the stock is not expensive at this juncture, and it does not capture the long-term potential of the company. For now, they've initiated coverage with a buy rating and a target price of 694 rupees per share.
Okay, that suggests an upside of almost 150 rupees on Titagarh Wagons. We'll try and get the management also to talk to them about whether that is something which is possible or not. But what's been the management takeaways from MOIL? Because they have been meeting a whole host of analysts. What's the latest update coming in? What's the guidance they are sharing with the street? Let's go across to my colleague to find out more on that.
Well, yes, in focus we are having MOIL, and they had an analyst meet, and the important takeaways include the volume growth is expected to come in between 20% growth over the next 2 years. Apart from this, also management commentary was especially bullish when it comes to the costing part, as they have mentioned that the cost of production that is expected to normalize to almost 6,500 rupees per ton from the current numbers of 6,900 rupees. Apart from this, also over the next 10 years itself, the next wage revision will kick in, and that is why it offers stable costs for the company. Apart from this, also there is expected that there would be incremental production coming in at least 3 sites across the country. Now, considering a huge export dependence, they are actually very bullish when it comes to the export prospects, and they're actually currently looking for a JV with GMDC for expansion. Now, the most important thing is, of course, the company is not facing any difficulties when it comes to mining lease renewals, and they are well placed that most of the leases are actually extending between 2040 to 2050, and there wouldn't be any additional royalty. Apart from the dividend policy is something which would be in focus for the company, and they have allocated roughly 30% of the profit for the dividend allocation, while the rest will be actually involved in the growth projects. Now, looking at the stock itself, the stock is up almost 15% from March lows itself, and a recent broking note came from Antique Broking, where they have maintained the price and keeping the target price set at almost 206 rupees per share.
Okay, we'll leave it at that, Sharad. In the meantime, JP Morgan and HSBC are pretty positive on the NBFC sector, with Bajaj Finance and L&T Finance emerging as their top picks. That's for JP Morgan. Meanwhile, HSBC has raised target prices for a whole host of them. Lisa joins in with more details and the entire list.
Well, yes, a couple of brokerages have come out on a note on NBFC sector, and they're quite bullish on it. JP Morgan as well as HSBC. Now, what JP Morgan is saying that that the NBFC sector loan growth that is high and it's outpacing banks, and even HSBC they are of a similar view, as they say that the outperformance in the NBFC sector that could continue as the EPS CAGR that diverge versus the banks, it's quite high, and an earning upgrade cycle that is also underway with multiple drivers in place. Well, HSBC has hiked the target price for several NBFCs like M&M Finance, Bajaj Finance, Chola Investment, SBI Card, L&T Financing as well, L&T Finance as well as LIC Housing. For JP Morgan, the top picks remains Bajaj Finance as well as L&T Finance. Now, why Bajaj Finance? Because they believe that the earnings compounding the earnings compound will be around 25% over the next 3 years, and for L&T Finance the valuations remain quite reasonable and attractive. And JP Morgan is also of the view that the investors, given the historical challenges in NBFC, they have under allocated on the sector, but given the state of the credit cycle and also the macro setup on the rates, JP Morgan believe that the investors will add this NBFC to their portfolio. So that's the word coming in from the brokerages on NBFCs.
Thank you, Lisa, for that. So a couple of brokerages and sounding quite sanguine when it comes to the entire NBFC space. But talking about FMCG, Britannia is one stock which has been hitting fresh record highs of late. And now we have another note coming in from analysts because they recently visited the company's plant in Ranjangaon. Let's go across to Vinny to try and understand what the key takeaways are.
So absolutely, in terms of this plant, Ranjangaon plant, why is it important is because one is the largest plant. It's the fully integrated plant that the company has now, and this is built across 146 acres, which indicates that there is further room for expansion on this plant, brownfield expansion on this plant for Britannia. And obviously, you know, Britannia has spoken about in the past of becoming the total food company. And in this also, this is a fully integrated plant. They have most of the lines in this, whether you look at in terms of the biscuit lines, then there's a line which is for the dairy. There's a line which is for the adjacency businesses as well. So obviously, most of the businesses are covered and coming in this plant as well. Now, the total outlay of the capex for the plant is going to be of around 1,500 crores. Currently, the plant accounts around 10 to 12% of the company's total volume, and that's going to start moving up and maybe reach somewhere upwards towards that 15-16% mark sometime soon as well. In terms of obviously at company level, when you look at it, the in-house manufacturing currently comes and contributes to 60 to 65% of the overall production for the company. And in terms of other than that, the company is also looking at a separate line for making cheese, but currently that is manufactured by contract packers. So yes, keeping an eye on that because there will be a separate line for that. And in terms of dairy also, there is an in-house production that they're looking to start by March 2024 as well. So a lot of capacity and a lot of the contribution will start coming from this plant. This is one of the first fully integrated plant as well. So keeping an eye out on Britannia on the back of this.
Oh yes, Britannia on our radar, as our graphite electrode manufacturers like HEG as well as Graphite India too. They've outperformed on a monthly basis. What's been aiding the move on the stocks? Ashesha is here to tell us exactly that.
Well, yes, graphite electrode manufacturers HEG and Graphite have been buzzing over the last many trading sessions. In fact, both of them have gained 28 and 17% respectively over the last 1 month. So what's the story all about? For that, let's understand what do these companies do. They manufacture graphite electrodes that is used in steel manufacturing via EAF or the electric arc furnace mode. Now, this mode reduces carbon emissions by as much as 75% versus its traditional modes, and hence decarbonization theme is helping these companies come up with positive outlook at least over the medium term. In fact, capacity additions over the globe, across the globe, is also the reason why these stocks have been buzzing over the last many trading sessions. Let's also understand industry positioning then. There are only 7 electrode manufacturers across the globe. Competition from China is also very limited, and significant entry barriers due to specialized technology that is required to manufacture graphite electrodes is why the industry positioning is also very strong. As far as near-term challenges are concerned, management management of HEG in its investor meet a couple of weeks ago had highlighted that the first half of FY24 is expected to be weak as far as demand is concerned. Now, if you look at the stock performance, HEG has outperformed graphite over the last couple of on a year-to-date basis, and this is because HEG has installed additional capacity at a time when global peers aren't. Apart from this, they've also forayed into anode manufacturing from lithium-ion batteries, and that is the reason HEG has outperformed graphite on a year-to-date basis. As far as the key risks are concerned, cyclical nature of the industry, dependence on imported needle coke, which is the main raw material that is required to manufacture batteries, are the key risks that the industry faces. Let's also talk about the brokerage views then. Jefferies has a buy rating on HEG with a target price of 1460 rupees per share. And on graphite too, they have a buy rating with a target price of 420. Incred, meanwhile, recently came up with an initiating coverage road whereby they have an ad rating with a target price of 2462 rupees per share.
Okay, Sesha, thank you so much for joining us with that update coming in for HEG as well as Graphite India, and what are the tailwinds for a couple of those counters. But shifting focus and getting you the big voices from corporate India as well, on our 14th anniversary, we caught up with the movers and shakers of India Inc. to get you a clear picture on how they expect demand and growth to pan out in the future. Listen in to some of those big voices.
But these are shortages really in the supply chain. On a global scale, the manufacturers are dealing with a shortage of supply chain and a shortage of materials and parts and so on. During COVID, many of the factories in Europe and the US have reduced their capacity, and clearly they are not able to catch up with the demand which is there today. So today the number of planes on the ground for Indigo, we've communicated the last time, they're in the high 30s, which is a significant number. Having said that though, to your question on the losses, at Indigo we've taken actually a whole range of initiatives to deal with that, to mitigate if you wish. So we've extended some of the leases.
So beverage parts, I would separate it into two pieces. One is packaged beverages and one is ready to drink beverages. Packaged, I think on the tea front, it's a neck to neck, race with our close competitor. The idea is we need to continue to expand distribution, branding, etc. in that space, and we're on a pretty strong footing. Coffee, I think we've got a long way to go. We're still, I would say, low single-digit market share. There's no reason why we shouldn't be a high single-digit market share.
We do believe that Tata Power will play a very important role in the new technology areas. Renewable, of course, will be there, but renewable not just as standalone solar or wind, but renewable in terms of how do we package it on round-the-clock power, on peaking power. And that's where I think some of these solutions on storage, some of the hybrid solutions with pump storage, battery storage, some of the hybrid solutions, even on demand response and demand side management will happen. And we strongly believe that the 24/7 power, renewable power is achievable. It will be reliable power. It will have resilience in terms of backup of supply at N-1 or N-2.
And on to some top fundamental ideas then. Hear it out from Dipan Mehta from Elixir Equities as to what are the stocks that he's betting big on.
We like this entire capital goods space, and two companies which come to mind which are quality players over there. One is Praj Industries, which of course is pursuing the ethanol opportunity, and second is VA Tech Webag, that's been also moving up, scaling to new highs. We all know the importance of water. I think it is front and central with every agency, state, central, as well as private sector. And VA Tech Webag is a quality player in water projects. They have an international footprint as well. Both the valuations, I think, compared to the business dynamics are reasonable, and they're sitting on multi-year order book positions, which we like. So I think there's good earnings visibility as well. But again, I think, these stocks have run up. One must, be a bit careful and do their own due diligence before investing in them.
Devin Choksi joins us now. Devin, bye, good morning. Thank you for joining us. Reliance ka samay kab aayega? Market's at an all-time high. Reliance nowhere close to its all-time high. Reliance ka samay kab aayega?
Yeah, Nikunj, good morning. As far as you and I am asking the same question, because as far as the fundamentals of the companies are concerned, they have never been in doubt. On the contrary, I think they are probably much more clear than what they were ever before. Geo platform, retail business, those consumer-facing businesses, they definitely, I think, show a distinct amount of signs of, I think, steady growth, sustainable growth. At the same time, I think the industrial businesses in form of refining, exploration, petrochemical polymers, there too, I think the larger pressure which was there up till now, I think that has gone away, and maybe they are maintaining their delta so very well in each of the products. So from my perspective, I look at this company from the long-term investment, of course. I believe that I think the business of the company remains absolutely strong, solid, and sustainable. They continue to grow at a steady pace of growth, even on a larger balance sheet like what they currently have. I believe that I think the stock requires a follow-up, I think, as far as the funds are concerned, to add into the portfolio, the weightage into their portfolio. Should that happen, then probably I think you are likely to see the larger amount of participation into the stock price of the stock. But as I say, fundamentals remain absolutely convincing. I think it could happen anytime as we are talking today.
Nuresh, big movement in HDFC Life. Is the stock finally, or is insurance sector now is the insurance sector now all set to participate?
So this is a tough one because post the budget fall, the announcement fall, the stocks fell off sharply, and now the recovery has been unusual. So if you were to look at a lot of these names, the expectation was low of a recovery, but the recovery has been very smart, whether it is ICICI Pru or HDFC Life. So the problem is, can it break out? Tough call, because the 620 mark has been a problem for HDFC Life for the last 1 year roughly. And this used to be a support previously when it broke down in 2022. So I would be a little cautious here because the risk reward is not great. But if it starts sustaining above 620 for a few sessions, that would indicate that there is a trend change in a big way. If you look at 620, it happened in 2023 Jan and September as well as in May of last year. So a very important resistance here. Same is the case with a lot of insurance names wherein they are coming back to previous resistances. So SBI Life, which was the leader, is back to that 1300, 1330 mark, a problem zone for the last 1 year. So out here, not very confident, although the charts are looking very interesting, coming close to resistances. Can it break out? A tough call to take. Would wait for a few sessions for some more price action.
The interesting news in Patanjali. This is again what they've informed exchanges, that they will be meeting the management of GQG, now Rajiv Jain, that famous fund which bought into Adani. Now bear in mind, before you get excited, as per the new guidelines, when companies are meeting few funds, they have to inform well in advance, whether it is at an investor conference or it is in private meetings. So just because the management is meeting GQG, that does not mean that they've invested in it. So please don't speculate. B, Patanjali Foods in this case has to bring their promoter holding down as per the new SEBI listed guidelines. So they will have to either do a QIP or a OFS. What we understand is that it would be largely a QIP. It would be OFS because they really don't need that much of capital. So why would they dilute the equity? But they are meeting institutional investors in next couple of days, and the roadshow has been organized by Antique. Devin, why am I bringing up Patanjali is because this is one stock which is nowhere close to its all-time high, and the fact that they have to bring the ownership down and the roadshow had started. What is your view on Patanjali as a stock?
So I think remain absolutely convinced about the underlying story of the business in each of the vertical. So in personal care, even in food, I think this company has been basically making significant amount of progress. What probably it lacks, I believe, I think is the kind of an approach to sell, I would think. Because currently the way in which I think the products are sold, they are moving steadily. I think they have penetrated the hinterland so very well. However, I think in order to get the premium segment out of this particular product, something which they have started with, I think by creating their own stores, I think that has to get a little bit of more momentum. Should that happen, then I think there is a margin expansion possibility that is also equally important for this kind of business, which is currently I think not happening as much as one would have expected it to. So that is where probably I think the influence of right kind of investor could also help. And I mark my words carefully because I think ultimately I think you require the good quality support as far as I think the underlying thinking process is also concerned. That is where some of the right kind of investors would probably help. In my viewpoint, I think the stock remains relatively more convincing. The growth path is, I think, relatively more steady. The customer segment has, I think, remained loyal to them all along. So, in my viewpoint, I think it is a time where probably you need to carve out your niche by way of, I think, creating some kind of premiumization in your product categories, and that's where probably you could see higher amount of margin as well. Let's see how exactly things turn out, but I remain confident about the possibilities.
Okay, so that's about Patanjali, the stock definitely on our radar. But then there are a couple of other stocks which are there on editor's radar. It's Dixon Tech as well as IDFC First Bank. Because both of these stocks have seen a massive rally, right? Let's start with Dixon Tech. That entire phase of electronic manufacturing has been the darling of the market at this point of time. Do you think there are more legs to go for this one?
See, the long-term picture for electronic manufacturing and the manufacturing in India, I think still has a long way to go. I think it is just at an incubation stage. I may not be surprised that this really could be the mega trend for many decades to go. But markets are markets. They tend to always preempt and overreact in the short term. So I think specifically when it comes to Dixon, look, they had a bit of a challenge same time last year and the stock came down, but it is up 62% now. Yeah. Remember, this is not like a 30% return on equity business.
Yeah, the margins are very
The margins are very thin. Ultimately, it's a business where the top line is great, but margins in a sense are very limited because that's the nature of the business you are in. So my limited point here is that after a 62% run up from the low and a 16% run up this year, the stock is trading way above its 5-year average. Yeah. When a stock is trading way above its 5-day average, the limited re-rating is not there unless the business is changing. See, I can argue and say that if the like Praj, the business changed. For Dixon, the business is only going to expand, but margins are not going to change in a dramatic manner. So if the valuations are way above the 5-year average, and if you look at the P multiples right now, I think there is case for Dixon now to hit a pause button.
Is that going to be the case for IDFC First Bank as well? Because that too has been on a massive rally of its own, while rest of the banking names have been underperforming. This one has been sitting at life high levels.
I think this one, IDFC Bank has got its mojo back.
Yeah.
It's one of those banks which has created a strong CASA. I think the return ratios are strong. The entire NPA is not a problem for them. And they've demonstrated the ability to turn around by using technology and the advantage of big data. So I think this is just the beginning of IDFC, which in a sense, post the merger, they've struggled because of legacy issues. I think now they are in a fine fettle, and at a time when medium banks or mid-sized banks have really struggled to get liability franchise, they've not disappointed on that front. Now you may argue and say that it is above the 5-year average, but the difference between Dixon and IDFC Bank is that I see incremental jump in earnings for IDFC Bank, and I see a lot of visibility for FY24 and 25. It will outperform the sector, and within the sector it has a low base, so I think it has a long way to go. It may be at the most bullish consensus target, but the way I look at IDFC Bank is that I expect the earning estimates to be revised upwards, and for Dixon, I don't think they will be revised upwards. So it's both of them are outperforming stocks, but both of them are on the different ends of the spectrum.
Very interesting, because cycle is what really matters for stock prices, while Dixon Tech is towards, the fag end of the cycle and has already peaked out, perhaps, at least for the near term. IDFC First Bank, Aisha, has more legs to go.
Oh yeah, absolutely. And let's move on. Let's talk about some of the other stocks that are also going to be buzzing. Here's Anand Tandon telling us why he likes Hero MotoCorp.
Hero Motor could be a surprise because they have been one of the laggards losing market share consistently, but they seem to be now indicating that they have a whole new set of launches. The only risk is that the launches may fail as many of their earlier launches have, but considering that their pipeline right now looks robust and the valuation at which they're trading is extremely attractive, I think they're close to 4% dividend yield for a company which has been around for such a long time. Also, the market at which the end of which they so far have been traditionally servicing, which is the lower end of the motorcycle curve, that I think the rural markets will do well in the second half of the year, and therefore I would argue that Hero Motor seems to be in a space which is both attractive from a potential growth point of view as well as the current valuation expectations.
Another stock which I think is worth revisiting, Devin Bhai, I think is HDFC Life. Insurance really has been the black sheep, so to speak, in this entire market rally, and they've just not chipped in. The price action in HDFC Life on Friday, other life insurance companies also, they in a sense outperformed on Friday. Has good old insurance sector, Devin Bhai, rediscovered its mojo?
Nikunj, I think in previous 2 years, if you see the valuations of these life insurance businesses, probably I think they remain relatively on elevated levels. And as a result of which, I believe that failed to attract, I think, the investors because they were already premium and trading expensive. But in such last 4 quarters or so, if you see how the trend has been moving for the new insurance business premium, I think you find that selectively in respective pockets, you are seeing the 20% kind of a growth continuing on a yearly basis as far as the new business premium is concerned. HDFC Life in particular has created a portfolio which is quite a balanced portfolio. On one side, they have got a single premium policies, the par and the non-par policies that they have. And as a result of which, I think the basket is quite, I think, equally distributed. So in a given situation, this company will steadily grow. They will not grow exceptionally fast. Neither they will go down, I think, very badly, bad situation. They will remain steady growth providers. And that is what is probably market is adjusting to, I believe, as far as I think the understanding of the business is concerned. Maybe as I explained earlier, the price part has always remained, I think, a little bit more premium because of variety of reasons in earlier period. That also got adjusted. I would like to believe that I think this business is expected to provide around 20% plus kind of a return on a yearly basis if it remains on this kind of a steady format for a good period of time hereafter.
You know, there are three stocks which are worth revisiting. First, I think, is Tata Chemicals. It is an F&O ban. Now, this stock has not participated at all. Last 1 year, Tata Chemical has been one of those, underperforming stocks. Soda ash prices literally have been all over the place, but it is still an F&O ban. That makes it very interesting for me. The second, I think, is India Cement. It tends to be a very high beta stock. Every time when the stock goes higher, the whisper rumor, the whisper they start, this will happen, the promoter is exiting, we are looking at an M&A activity there, and I've been hearing this from last 7-8 years. Because Radhakishan Damani has ownership there does not mean that there is going to be an M&A activity there. That is India Cement for you. It is a 50% this year. It is also an F&O ban. And the third one, again, Chinese whispers or the Dalal Street whispers that things could be changing there. L&T Finance, it has done rather well for itself. It is also an F&O ban. So, Nuresh, let's look at India Cement, L&T Finance, Tata Chemicals. Very unusual stocks which are part of F&O ban.
So the list has expanded. There are almost 10 to 14 stocks now, and that is generally not a good indication. So out here, India Cements, I would keep it on an avoid because purely it has been a stock which keeps seeing this rumor mills. The stock goes from 250 back to 150. And this has continued for a really long time. The last 2 times also it looked like a breakout. It did not do well. So L&T Finance Holdings is the one which looks interesting on a dip. If it goes back to 110 to 112 levels, that is the price point you want to get in. The longer term structure is still positive. And NBFCs as a space look interesting. If one is looking at a derivative ban as a data, then the interesting thing is today BHEL gets out of a ban. So that could see some price action on the upside.
So that's about a couple of those counters. BHL is something that you're positive on, and L&T Finance Holdings is also the view that you just heard. But Devin, wanted your take regarding the railway stocks. They have been chugging along quite nicely. Today, of course, there was that initiation that came in from Antique on Titagar, talking about an upside of almost 150, 200 rupees. Do you concur with the view that these railway stocks and the capital good names is the space to be in?
Yes, I think given the fact that the government is the biggest spender today in infrastructure space and railways included in it, I believe that there is no second thought or no question asked on this particular subject of you seeing higher amount of visibility of order book. And I think government has already laid down the roadmap for 10 years that they want to spend about 110 lakh crores in building the infrastructure in the country over 10-year period. This year's budget has been set 10 lakh crore. Last year, I think it was 7.5 lakh crore. So obviously, I think a good share of money is definitely flowing towards the infrastructure segment, and railways, I think, definitely getting larger chunk out of it as well. In my viewpoint, I think the railway stocks will continue to see the steady to higher rate of growth because of this particular spending by the government. So demand side scenario remains absolutely very strong and convincing. On the other side, I think you have the challenge in some of expanding your margins. And that is where I think one will have to be a little bit more mindful about selecting the stock in the portfolio. Because being government companies or government is a main buyer, I think these companies do not get higher amount of margins. And as a result of which, I think the challenge would be always that I think they will be executing larger order book, but I think at a contained margin. Given that situation, any kind of a premium valuation in the stock price would mean that I think the stock will probably underperform over a period of time. So that is where I would be mindful about it. That whenever I think market gives opportunity at a corrected valuation, some of these stocks could remain a good opportunity to buy or pick up. I think February, March was relatively a decent period in which probably we ended up getting some opportunities. Similar opportunities, if we do get in the future, probably I think they should be considered for investment at a lower valuation.
So that railway capex theme is something that you're watching out for. But what about defense? Now with this Prime Minister's impending visit to the US, the focus is back on the defense names. Devin, do you think the upside is already priced in? Because it's a long gestation period. It's not going to turn overnight and you will not get the revenues just say in a quarter or two for these companies.
Absolutely, Anisha. I guess think is more or less the same rationale which is coming up here too. That on one side you have got the defense portfolio opening up, you are getting higher amount of visibility for order book, demand side scenario remain intact for most of the companies. On the other side, the margins are going to be tight, they are not going to be so easily expanding. And at the same time, I think the valuations will run up little ahead of time because of the positive news flowing in. Given that kind of a situation, I would like to believe that I think while the fundamental prospects remains very strong and convincing for defense as a sector along with railways, I would like to believe that I think you will have to buy when the market is giving you a valuation which is neglected or relatively more attractive, or call it simply in one word that where the margin of safety is available. Should that be the situation, that would be a time to buy into some of the defense stocks. I remain positive, but for the reasons which I explained, that any early attempt of making the valuation reach would probably fail the investors and they will have to settle with the stock at a costlier price in their portfolio. So buy when market gives opportunity at lower levels.
Let's hear out some more stock ideas, and we'll start with Punjo, Vijay Kedia, and what essentially Vallabhbhai is bullish on.
Yeah, the Burger King company. So this is a beautiful business. It's in the infancy in this country. Last few years, they have been struggling with many things. And now this company owns the business of Burger King and Popeye in Indonesia also, the same listed company in India. So I feel they are well set for growing much faster and, creating cash flows in the future. For me, if you ask me, Tata Group is going to outperform all other groups in the coming years.
Index is a counting of 21 is happening index, 21,000, 42,000, 63,000. And I think that next stop should be 84,000 in 2 years from now. And of course, 100,000 is just a destination, I think, and miles to go for index. The only bet I have taken in electric, maybe some small startups. I have invested in some 2 or 3 some small startups. But significant investment I have made, that is a Loto, and I am bullish.
There aren't many countries where we have the 3 balance sheets all aligned, all healthy. That I call only solvency. It has already, established its value as a regulator, as being now we are ahead of the curve or all along the curve. We are not behind the curve in any manner. Now, whether from a growth point of view or inflation point of view, I think we will have a right to ask for manufacturing, space, manufacturing, should I say, supply status. Until then, it was not expected. But now it is inevitable, I think. So it's going to happen. I had just little doubt about it. The manufacturing boom is coming.
EaseMyTrip is a different kind of company. It is actually probably the best one of the new age companies, at least, in terms of it's profitable, it's bootstrapped. It's not been burning cash like the other startups. So that's one of the preferred ones in the overall ecosystem of new age listings. But there are companies which are into visa processing, which in my view, after COVID, the whole world tours and touring, traveling, etc., is in an upward momentum. We see data from across the world in terms of travel bookings. So all that benefits a particular company listed in India. So I mean, I'm extremely optimistic on the services space, on the manufacturing space as well. Some very interesting plays out there.
Oh, well, yes, and talking about the manufacturing space and the interesting plays which are lined up, let's listen into what Manish Shokhani thinks of the same, because electronic manufacturing services is likely to emerge as a major theme in the country. He talked about how Apple is likely to be the G moment in India, the internet moment in India. Listen in to his take.
Apple moment in India is staggering for what has happened, and I think it's as transformational as when G came to India for software services. So Apple's come in and already they are on a run rate of $10 billion exports from India this year.
iPads are also coming soon.
And their stated ambition is to go to 100 billion exports. Now imagine what it does for the ecosystem. So when a Maruti came, you know what happened to the auto and ancillary industry. When G came, what happened to the whole software services industry. I think the next generation of kids coming out of college will not want to go to software, they will go to hardware. Because that's the combination of hardware and software together. Yeah, and you see beneath the surface what's been happening to the EMS companies.
So is that the new thing now? Next,
I mean, it's been the theme. I mean, we've all been buying it, participating in, all of them. So, 5, 6 of them, and they're still at the bottom end of the sort of value stack. But when the Tatas will put up their semiconductor stuff and we start going deeper into that ecosystem, it's inevitable, because whatever we are importing today, in 10 years, we should be exporting that.
It's such a powerful point. And just think through it what Manish Shokhani has said. When Maruti came to India, India was not in car manufacturing. But then came the entire supply chain which got created, because the car will need tire, the car will need engine, the car will need glass, the car will need wiring, and then the entire ecosystem of the auto ancillary sector got created. If there is one company which has surprisingly, there is one manufacturing sector where India is globally competitive, I think is autos, whether it's two-wheelers or four-wheelers. Then came the GE moment. What was GE moment? Jack Welch, the former or the ex-chairman of GE, decided to outsource from India. The call centers they started, because there was a labor arbitrage. And then the entire body shopping units were set by the Patnis and the Infosys of the world, and the IT revolution has started. In India today, the IT exports are $250 billion. That is in comparison to what oil Aramco exports every year. So Indian IT exports are equivalent to 2 years, 1 year ago, what oil Aramco actually exported, or Aramco actually exported. That is the size of Indian IT industry, which till about 30 years ago or 35 years ago was non-existent. So for a non-existent sector to come and see an export of this size, I think is unreal. Oil was always there in Middle East. It is something which nature has blessed them with. They have not done anything extraordinary. But India is where this entire IT services got created. But what's next? In markets, you don't make money by buying past trends. You make money by predicting the future. And this is where I think Manish Shokhani seems to be making a point that Apple has come into India. Tim Cook has come and opened a store. But no, it's not that. The backstory is that Apple has started making iPhones in India. They are looking at making iPads in India. And Apple is a piece of art. Right, Anisha? You're an Android fan, right?
I am.
But Apple is a piece of art. It is a piece of art. And then piece of art, when it gets created and manufactured in India, it just says that how good we are in terms of managing supply chain and cost efficiency. Which means in India, the manufacturing will start. And this is not going to be big manufacturing. It's going to be design-led manufacturing. Nano chips, microchips, semiconductors. And that's where I think the ecosystem is getting created. Markets are smart in realizing that. So look at the stock price of Dixon. Look at the stock price of Keynes. Look at the stock price of Sirma. Look at the stock price of, am I missing anyone? Sirma, Keynes, Dixon, Amber. These are the stocks which have done exceptionally well. So Nuresh, if one has to bet on this multi-year mega trend in terms of manufacturing, what is that one stock which we can say catch it young and see it grow?
So this is a tough one, because high growth, high expectations. We saw this happen with Dixon. It saw a 40-50% correction. So the point here is one has to wait it out, because once it catches a fancy, we see a huge move and then a fade-off move. So I would wait for a fade-off move and then again look at a Dixon or any of the new, something like a Keynes which has come up. Wait for a dip from here on. I think in the near term, they're overdone. And say whenever we've heard about multi-decadal stories, it's generally a time where it sees a fade off. We've seen that happen in the last couple of years with chemicals. Then we saw digitization. So for now, I'll be a little wary of this sector for the near term.